For anyone I've not met before, doesn't know me, my name's Tim Jones, the Sales and Development Manager here at Integrity365. This is the second in the series of our webinars. Some of you may have attended our first. It was a very topical and fascinating presentation on sustainable investments. If you didn't, and it may be something of interest to you, reach out to your advisor, pop over to our website, there's a link, or feel free to pop me in a message in the chat function here. Be more than happy to provide you with a link to it. I'll kick off for now and welcome everybody to the second of our Integrity365 webinars. This evening, it's maximising income through the construction of your portfolio. Really pleased to welcome our guest speaker, Andy Zanelli. Andy, welcome. Andy's got over 30 years experience in the financial services across a range of areas: tax, trusts, retirement, estate planning. Really grateful, Andy, for you giving us your time. Andy, I think it's probably time to hand over for yourself to start. So over to yourself.
Thanks, Tim, and good evening, everybody. I'm going to share some slides to just illustrate the concept that we're going to talk about tonight. And it's a very interesting area to look at the moment. So I'm just going to share my screen. So yeah, we're talking about Tim said maximising income through portfolio construction. I kind of talk about this as just the power of tax planning. My starting comment when I do lots of presentations now is that for me, and as Tim pointed out, some of you might not think I'm old enough, but I have been doing this for over 30 years. And I've never known it to be as flexible as it is today. I commonly say in presentations, this for me is the golden age of financial planning, the ability to maximise people's tax positions, their portfolio construction at different levels in the current flexible environment that we've got. It's just amazing. So to me, there's a huge amount of kind of power within tax planning that can be done by advisors these days. And it's not just you know, the tax position that we're in at the moment. It's hugely flexible, which I'll show you in a minute. The range of wrappers available now and the flexibility within tax wrappers, so things like pensions, bonds, ISAs, collective portfolios, investments that some of you, if not all of you, will hold in some number or other. They're tremendously flexible these days. And you've got the ability to produce different types of income from different investments. So you've got almost 3 levels of flexibility that are available for advisors to use to maximise the portfolio construction and produce powerful tax efficient income. And it's a case of looking at all the taxes in the round. So you need to consider everything. It's pointless to me managing one if the other one gets out of control. So we're going to look, you know, you use income tax, the allowances that you've got there, capital gains tax. We want to mitigate inheritance tax if we can at the same time. Why wouldn't you do a package solution which does everything? And for those of us or those clients that are facing into a pensions tax charge called a lifetime allowance excess charge, we would look to manage that as well. So it's a combination of a client's position that's really important and getting that strategy in place. Now, I'm going to show you some slides. There are a number of slides. The one thing I would say all the way through my presentation is it's the concept that's important to me. I wouldn't worry about the numbers. A lot of the numbers are on the slides just really to prove the point of how we get to the position that we're in. So they're available there if somebody wants to look at them afterwards. The first slide is UK tax allowances. Now, if we go back a few years, some of these allowances didn't even exist. Now we've got new allowances like a starting rate band for savings income, a lovely tax rate of 0%, a personal savings allowance, which if you're a basic rate taxpayer, and if we can make it so somebody's a basic rate taxpayer, you get £1,000 allowance there, a dividend allowance of £2,000. We've still got a very generous CGT annual exemption, 12,300. Can we utilise that? And we've got the personal allowance, which today is incredibly generous at £12,570. If we go back 10 years, it was probably closer to £5,000. So it's grown very significantly over the intervening years, and is very kind of useful these days when we blend all of this together. So if you take those mainstream allowances, you can get tax-free income of just under £33,000, and that's not looking at other options that are available like tax-free cash, tax-efficient income from bonds. And there's another allowance, small one, but a marriage allowance that's available if you are a basic rate taxpayer and your spouse is a non-taxpayer. You can claim some of their marriage allowance as well. My message is it's complex, but it is very, very generous when you can blend it together with this, with the tax and income streams that we can produce. Now, this slide, tax bandings, we know the main tax bandings in the UK, but our friends north of the border have their own tax raising powers. And the point I'm trying to make here is that in Scotland, they've decided to make it a little bit more complex. They've got more tax rates at different levels, and they become higher rate taxpayers at different levels. So what? A lot of us live a long way south of the Scottish border. Wales are looking to implement their own income levels as well, income tax levels. And I even read an article once when I was on the train to London that Yorkshire were arguing for income tax devolution so they could introduce their own income tax rates. And if you give it to Yorkshiremen, you've got to give it to Lancashire people, then the Cornish people will want their own. Where will it all end up? My point is it's just getting more complex. And that's where the power of advice really comes in, understanding the navigation through all of this. Again, when we get different types of income coming in, they're taxed in a particular order. So understanding the order and then making sure we've got the right types of income coming in from our portfolio to be able to drop it into the right part of the tax calculation, again, can create some great results. And I'll show you a case study in a few minutes. So it depends what type of thing is. If it's salary, rental, that type of thing, that would go in first. Then you would look at bank and building society interest, offshore bond gains, that type of thing. Next comes dividends from shares and collective portfolios, then other types of bond income, and then capital gains right at the top. So there's an order of taxation that overlays this complex set of allowances and this complex set of tax rates. But what we're trying to do here is produce the right income at the right level at the right time to make use of all those allowances. So we want to start by filling up the personal allowance. We want to be taxed if we can within the basic rate band at worst. And what we look to try and avoid if we can is higher rate tax. Most people that I speak to aren't desperate to pay more tax. Most are quite happy to pay their fair share, but don't want to pay too much. And if we can manage it down to some degree, then that's a great outcome. So it's making sure that we can get the income into that basic rate band or the tax liability into that basic rate band, but also maximise those allowances and exemptions that are really generous that build up towards that £33,000 worth nearly of tax efficient income. So that's what we're trying to do here. Tax-free income first and foremost, and then hopefully anything else, let's minimize the tax into basic rate band. Now the slide here is really important because there were changes, particularly to pensions legislation in 2015, that turned the way that we look to take money from our savings when we move into our retirement phase or our winding down from work phase. It changes the way we look to withdraw money from a portfolio now, bearing in mind tax. There was a big change to pensions. So when we're saving money, I was getting confused then with my spending, which I always want to talk about. When we're saving, we would look to maximise pensions because they're incredibly tax efficient. ISAs, fantastic savings vehicles. You know, the tax breaks available through those are superb. Collective funds and investment bonds, again, tax wrappers that give very good advantages, but not quite as much as pensions and ISAs. So that would be your savings strategy. And then when you look to take the money out to spend it, that flips around. you would look to, in lots of cases, draw down on your bonds and funds and leave the ISAs perhaps a little bit longer. And a lot of people now are leaving their pension till the very last thing that they start to draw on. And that's around pension death benefits being incredibly attractive. So what does all this mean? You know, we've got this complex environment, we can go and take advice and we can fill up these tax kind of bands. When we're earning money, we haven't got the flexibility that we have towards the phase when we're going to start drawing down on our portfolio. So I'm going to do a case study where if I was earning money, how much money, my starting position, would I have to earn to end up with £100,000 in my hand? Now, you might say that's a lot of money, 100,000 of income. It's the concept that I'm trying to put across here, and it's just a nice round number. So I would have to earn 167,600. So the tax computation is there on the screen. I would physically have to earn £167,000 and my effective tax rate would be over 40%. Now, a lot of you would expect that level of taxation. You know, there's significant earnings, 40% would seem about right. So that's in my savings phase. When I'm earning money, if I wanted 100,000, I would have to earn 167,000. So when we look to take money from our portfolio, when we've gathered our assets together, and again, we should be looking to get a lot of these tax wrappers in place early so that we've got them available later on to use. And your advisor will talk to you about that type of thing during your reviews and meetings. So how can we use these tax wrappers? How can we diversify the risk in the investments, because we've got these different tax wrappers, maximize those reliefs and exemptions? And the exercise I was trying to get to was avoid higher rate tax, which is 40%. Can we do that and produce a significant level of income? And also at the same time, create this legacy for the next generation and protect that legacy, which is very, very important to lots of people today. This is a kind of all-in financial planning. So the question that I'm going to start with is, how much investment and pension wealth could a client have, which could produce a significant, sustainable level of income? We're talking about something that will run on all the way through the journey for the client, doesn't attract higher rate of tax at 40%. So that's what we're trying to do here, and preserve that capital value, that estate planning, intergenerational wealth aspect. That's what I'd be looking at. There is no one size answer to this because every client is an individual. That's why we go and get financial advice, because we are all individuals, our circumstances are very different, and there's all these complex rules to navigate to get to that optimal position for us personally. That's the real thing that we want to achieve here. But you can combine tax wrappers together. Let me move my case study on. My client now has reached 60. The age doesn't matter. Actually, the size of the client's portfolio doesn't matter. It's the concept that I, again, want to get across to you. They've got what I would consider to be the 4 main tax planning tools that most people in the UK will have. We talked about them earlier. They've got a pension fund, which is their self-invested personal pension. They've got an ISA, very healthy ISA portfolio. They've got a bond, again, very, very common, and a collective portfolio, all kind of split equally apart from the pension. Now that's £2.5 million worth of investable wealth. But again, this is effective at every level. So if you can do this for somebody with £2.5 million, you can do it for clients with any size of portfolio. They want this net income of £100,000. So how much do they have to use of their investments, and what effective rate of tax? Remember, if I'm earning, I'm paying an effective rate of 40% to get my 100,000. If you took the traditional strategy that people used to do, they would start to draw their pension. Now, when you start to draw your pension income, you produce taxable income, quite significant taxable income. Some of it is tax-free cash, so we would take that into account. Again, the numbers aren't critically important, they're just for illustration purposes. So they take a withdrawal from their pension, and they don't draw money from the offshore bond or the ISA. And some income is just coming in from their collective, because that just happens every year anyway. So in this example, because you've taken a large amount from the pension, it's taxable income, we would look at the tax position for that income and work it through. We've got taxable income here of £94,000. When we look at the allowances that have been used, we've used the personal allowance because that is the first one, and then just the dividend allowance. We seem to have lost the ability to use those other allowances. And we've got a significant amount of taxable income. We then tax it as appropriate. The tax computation is there on the screen. The important thing here is the total income is £100,000 when you take this income and the tax-free cash through your tax position using those allowances that we talked about before. So we've done that, but is there an alternative way to do it? Let's have a look at just doing something a bit different. Remember I said when I looked at the order of taking money out of your investments has changed since 2015. Lots of people don't take money out of their pension. And in this situation, the client has decided to not take this taxable income from the pension, but to utilise income from other wrappers. So they're going to take some money from their offshore bonds because they've got the ability to use that as savings income and use an allowance. They take some money from their ISA, a withdrawal, which could come from income or capital, and ISAs are incredibly tax efficient. They've got dividends coming in from their collective portfolio, but they also encash part of their portfolio as well, because that allows them to use their capital gains tax exemption. So what we're doing here is we're taking the income from multiple wrappers and using all of those allowances and exemptions that I showed you earlier on. So the question becomes, if I take that level of income, and you'll notice here, the actual amount that I'm taking from my portfolio is £100,182. How could that possibly produce £100,000 worth of net income? Because we're going to utilise all of our allowances and exemptions. Pensions, massively tax efficient, but we're not going to take anything out of it because we'll leave that money to grow in a massively tax efficient environment. The death benefits on pension schemes are very, very flexible these days and are being used a lot by clients for intergenerational wealth transfer, because if you die before pre-75, the benefits are completely tax-free to the people who receive the pot for the whole of their lifetime. If death occurs post-75, it's just marginal rates of tax. So very, very effective. And it doesn't form part of their estate for inheritance tax. And it doesn't form part of your estate for inheritance tax. So leaving money in a pension scheme as long as possible is a fantastic strategy. The bond, we take some money from the bond. I won't run through exactly what's on the slide. This is just the mechanics that sits behind that your advisor has to grapple with and deal with, but they'll come to you and say, there's no tax liability for this because I've used your allowances and exemptions. But they have to go through this kind of calculation methodology, but you don't lose your personal allowance, which some clients might do when you're using this type of withdrawal strategy, and we've taken some money out of the bond and used an allowance. We've taken some money from the ISA, again, incredibly tax efficient, no income tax or capital gains tax on an ISA, either when it's in there or when you withdraw, so we can use that effectively. The collective portfolio, we've got some income coming in, which is in the form of a dividend, and we can offset some of that against the dividend allowance. And we're also making a withdrawal from that as well, which we can use our capital gains tax exemption to make sure that the gain is within that exemption, so no tax to pay. And the capital gains tax exemption, as I said at the start, is £12,300. So we can take a £23,600 withdrawal from this collective portfolio, no tax to pay, tax efficient income. Now, I'll show you the same type of slide that I showed before. If you remember, if we go down the traditional pension strategy, then we've only used 2 allowances. Here we've used all of our allowances and exemptions. And in fact, we've got all of them maximised and used. which means that our actual taxable income is significantly less than the £94,000 worth of taxable income we had when we were taking all of our withdrawals from our pension scheme. We've got £23,000 worth of taxable income, and we can use our allowances and exemptions. So what? This is the important bit, the so what. There's the client's tax position. Their net income after tax is £22,818 out of £23,000 worth of taxable income. They've only paid £182 worth of tax instead of, I believe, in the pensions, you'd be paying about £24,000 worth of tax. So using this alternative strategy, we've just drawn money across our portfolio. We've utilised all of our allowances and exemptions. And this really it's a busy slide, I apologise, but it just wraps it all up in one place. If we look at the traditional approach from the pension, that's how we've taken our money out. Our tax bill, our physical income tax bill would be £24,153. The important point here is you've got a net income of £100,000, but the effective tax rate that you've suffered is just under 20%. Now, you might think that's great, because if we remember the client who was earning their effective tax rate to get £100,000 worth of income was just over 40%. So we've more than halved it immediately. However, if we go down the advised route where we look across our portfolio and utilise all of our allowances and exemptions, don't take money out of the pension for now, utilise all the other wrappers, produce the income in the right order from the right investments that we've got in place because we've had them as we've been saving. The bit for me at the bottom is the powerful bit. We've got net income of £100,000. Our total tax bill is now £182, and the effective tax rate that you're paying is 0.18%. which for a lot of people is significantly more attractive than 20% or 40%, or in some cases 45%. So producing very, very tax efficient income from a portfolio with a tax liability of 0.18%, less than 0.2%. Now, there's another benefit from this, which is that, again, lots of numbers on the screen, but I did say we're not only looking to be really tax efficient from an income tax and capital gains tax perspective. Lots of people want to pass money on to their nearest and dearest. I certainly would like to do that. I'm not sure my parents have the same attitude, but we'll find out later in life. However, it's important to preserve your estate to pass down if that's what you want to do. For the client that went down the pension withdrawal strategy, they've taken money out of their pension scheme, which is IHT free. So they've actually left more money in their taxable estate. So if you looked at your inheritance tax position for that client after year one, you would actually have £1,910,000 to pass down to your beneficiaries. If you use the alternative strategy, because we've left money in the pension scheme, which is inheritance tax efficient, we've drawn money out of assets that would have taken a 40% inheritance tax hit. You've actually got, if the client unfortunately passed away, you would have a net estate of £1,972,000. That's £62,000 more as an intergenerational wealth transfer on top of the income tax saving that we've already had for the client. So I think my next slide brings that together in one place. If you go down the traditional route, you've got a £24,000 tax bill. Alternative route, £182. Traditional route, you've got less estate to pass down. If you go down the alternative route, you've got an additional £62,000. Now, just in the first year, that's a tax saving across the board of around, what, £86,000? And that, to me, it says it at the bottom, is the power of financial advice. Understanding in today's flexible but complex world how you can blend your portfolio together to produce the right income at the right time to use all of those lovely flexible tax allowances that we've got. My last kind of message is really what I've just been talking about is actually for a single client. That person was just one individual using their exemptions and reliefs. So if you are a couple, potentially you could have double the asset wealth that I've just talked about. You could generate double the income that I've just talked about and still have an effective tax rate of 0.18%. So the key message here is just within the legislation that we all operate in today, it's incredibly flexible, and getting good quality advice while you're drawing down on your portfolio can have huge savings for you and your family. So as I say, multiple tax wrappers is the kind of underlying theme here. People look for diversification in their investments, the funds, the investments that they go into. People should diversify their tax wrappers, have a pension, an ISA, some funds, and a bond if appropriate. That's where the advice is critical, but get those wrappers in place because it gives you flexibility. If legislation changes, which unfortunately it does, you can just dial back the income from one of the wrappers if it's more tax efficient to dial the income up on another wrapper. So if you've got them in place, you can just turn the income on and off as you need to as legislation changes. It allows you to use all of those allowances that are out there, and it does create significant tax saving if you get the right advice at the right time. I have to put a legal slide in there, but I'll stop sharing my screen very quickly because it's not an interesting read, and I'll hand back to Tim, who may have some questions. Tim.
Wow. Thanks, Andy. Thank you ever so much. I mean, I've been privileged enough to see Andy in his presentations a number of times before, but every time there's something else which leaps out. So thank you very much for sharing that. Yeah, open to anybody on the call to ask any questions that you might have. I think what I said before, if you hover over the bottom of the screen, there's a question and answer functionality, which you can pop your questions in there. And I have got a few questions, Andy, which I'll put to you if you're ready. Okay. I'll start off. How can I be sure that any legacy I leave is left for the benefit of my loved ones?
That's a great question. Control is something that lots of people want to have, you know, post-death. So the first thing I would always say is an effective and valid will. Up-to-date will is, you know, something that I guess you and your colleagues talk with clients about at your review meetings. I always ask the question in seminars, actually, how many people have got a will, and lots of hands go up. But when I say how many people have got an up-to-date and effective will, there's usually some hesitation because it needs to be regularly reviewed. So I would say the first thing to be able to direct your estate where you want it is an effective will. The second thing is you know, the use of trusts, I would say, is very effective. And we're seeing more and more trust planning being done at the moment, Tim, because of complex family circumstances and the ability to put money into these trust structures and have a little bit more control that it's going to go where you want it to, when you want it to. Lots of people just, you know, don't want to give large amounts of money to various people because at that point the control has gone. So trust structures, I would say, is something that clients should consider.
Okay, yeah, some really good points there. And I suppose the next one might lead on from that. Do all pension policies provide full flexibility of death benefits under the new legislation rules?
And that is a great question, because the answer is no. So when the legislation was changed, it was something that was really difficult to do, which the revenue sometimes aren't up for difficult things. So they allowed pension providers to adopt the new rules if they wanted to. So what does that mean for a client? It's really important to understand the options that are available to you, because a lot of older style schemes and many people who are coming up to the retirement piece will have potentially pensions that are built up 30 or 40 years ago. Now, some of those schemes will not have adopted the new rules, so they will not have the flexibility that is available. So yeah, great question. Don't just assume that everybody gets it. That's a critical question to ask. And again, one of the values of financial advice, because it's something I say to advisors all the time, make sure you understand exactly what that pension can and cannot do, because nobody wants to shock.
Yeah, and I suppose that comes back to that original point that I know you made right at the start, Andy, and you certainly alluded to at the end, the power of advice and regularly checking, because legislation is ever changing.
It's constantly changing. I mean, I always said to him, the reason that I love what I do is that it was always changing. But I have to say the pace of change now is even getting too much for me. And trying to keep on top of it all is a constant challenge. So I'll give you an example. A particular piece of pensions legislation changed in 2006. So it's been in existence for 15 years and it's changed 11 times in those 15 years. How do you keep up with that? Well, that's the challenge that faces us, and luckily we can pass on the benefit of that knowledge to clients.
Yeah, and I suppose it comes back to that real point that the not just the power of advice, but like you said with the wills, the regular review, the checking that everything is fit for purpose and up to date.
Critical, absolutely critical. Yes, yeah.
A great question. Another one which has come through. Will my current pension automatically give me the full range of death benefits available? I think you've probably alluded to that previously, but worth just covering it off.
Not automatically, no. It will do if your scheme administrator or trustee has decided to adopt the flexibility that is offered to them. Now, with most modern schemes, they will adopt it and have adopted it. But some of the older types or more bespoke type pension schemes may not have got round to adopting that flexibility. And again, it can make a huge difference as to both the tax position of future benefits, but also the control aspect, which you mentioned before in a previous question, Tim. Because some schemes will literally just pay out a lump sum death benefit to whoever, and that might not be what you want to do.
Yeah, so I suppose again, probably the interlinking of everything, and as you've proved with the tax wrappers, how everything has an effect on everything else. It's tying it in, and the power of that advice. And I know that our advisors look at that kind of holistic approach to make sure that no stone is left unturned. There's a killer question here. You can always be sure of a killer question. How can I be sure that I won't run out of money in retirement?
Well, again, a great question, to which luckily I don't think there is any answer. So what can you do to try and make sure you don't? Is I would say to get, again, I know I'm saying the same thing, but get some advice, which if you think about the previous case study that I've done, if you're having to only withdraw 100,000 in this example and £182 instead of £125,000 to get to your income goal, your money is going to last longer. And that is proved by the legacy part of the case study that I did. So effectively managing the tax position, continually reviewing it, looking at your income needs, cash flow forecasting, I would always say is worth doing. But I would say the main point, and Tim, you said it a couple of times, regularly review. Any plan put in place today is a plan that is valid today, but something could change tomorrow, which could nudge it off course. And when we get a year or 2 or 3 years down the line of that plan, those nudges could have significantly driven it off course. And that's where advice just pushes it back on course for me. So the answer to the question is, I don't think it is I don't think it's doable with a guarantee on it, but there's a lot you can do to try and make sure it lasts as long as possible.
Yeah, very sensible. Another great question here. Can I use historic losses when drawing income?
Historic losses for, I would assume, it's a difficult question actually without the context that sits behind it. I don't know whether we're talking about trading losses or capital gains tax losses or individual share losses on the wind up of a company. It depends. My two-word answer to most financial planning questions, Tim, to be honest, it depends. There's different legislation around losses for different taxes. Interestingly, there is some kind of consultation going on at the moment where the revenue are actually looking to make it more flexible to be able to use historic losses. So that would say to me there are certain circumstances where you can't. Capital gains tax, for example, as long as you've registered your loss, you can carry it forward indefinitely and use it at any point in the future that you get a gain. Trading losses could be different. You might not be able to offset them against income. So it's not a great answer, but the only answer I can give is it depends. And again, that's the power of advice.
Yeah, I think, well, you alluded to the actual, I think, definitive answer that one of our clients were looking for with regards to capital gains. They clarified it as you were giving it. Someone would like to pass on as much wealth to their family as possible, but also worried about leaving themselves with enough to live on in retirement. What's the best way to kill two birds with one stone?
I would say my underlying answer to everyone is to take appropriate advice. However, I think it's looking at it objectively and perhaps looking at it as not a one-off kind of golden bullet type answer. Lots of these situations where you want to pass wealth down to the next generation. And obviously, the longer the longer life expectancy you've got, the more difficult that decision is because you don't know how much you can afford to give away. So I think it's an approach where you gradually start to give the money away as your comfort around your income need becomes clearer as you get older, if that makes sense. You can also put things in place earlier which allow you to start that journey, but not to a great degree, and retain access and control to your capital. So I think it's very much adopting a phased approach and using appropriate wrappers at the right point in the journey. So estate planning is a great question, because estate planning, if I think back 20 years, was the kind of one-stop solution. Oh, you've got a problem, you need to do this. It's just not like that anymore. It's a constant review of your position, and as you get older, you can then afford to do something a little bit different, which might involve giving a little bit more access to your capital away. So it's a phased approach, I think, is the answer.
Yeah, and I think you also picked out on perhaps a couple of other things, just that sort of early planning as well, and the power of advice. And maybe one of the points you raised there comes out in one of the other questions. And I think what I'll say is, if anyone's got any final questions, please feel free to type them into the question and answer box. But I'll run this one by you, Andy. What are the benefits of using a wrap platform to maximize income rather than holding these wrappers separately?
It's getting a consolidated view. So you've got all of your wrappers in one place. The paperwork, the reporting is so much easier because you get a combined view, you get a consolidated tax voucher for each of your investments that are on a platform, a kind of wrap platform. It brings all of that together in one place. So if your client needs to do self-assessment, you can just produce one tax voucher which has got all the detail that they need, rather than routing through a load of envelopes trying to find that in various different places. Speed at which you can change investments, because it's all in one place. and you can go in and you can change the client's underlying investments or even their investment levels in tax wrappers at the touch of a button. The speed of dealing, that type of thing. There's just lots of advantages of actually having it all consolidated in one place, rather than you know, waiting for different points of the year to get sent something by one company, something by another. And of course, you know, charging becomes more beneficial the more that is invested in lots of cases.
Yeah, I mean, we all know that cost isn't everything, but it's always a nice additional bonus given the other benefits that you just alluded to, Andy. So thank you for that. I think that is the questions that have come in. Andy, I'd just like to thank you for making quite a complex subject very powerful and very interesting. So thank you for spending the time with us. May have raised many more questions with our clients. So I'd probably say anyone on the call, if you want any more information, you have any further questions, reach out to your respective advisors, because we'd be more than happy to follow this up with you. And to you all, I'd like to close by saying, you know, thanks for taking time out of your valuable evening and joining us. I hope you enjoy the rest of your evening, whatever you choose to go on and do. Many thanks and goodbye.